I'm Jonathan with the Yukon Project, and today we're going to do a deep dive on payday loans. A payday loan is a form of short-term, low-dollar lending for people who can't get traditional loans from banks or credit unions. They are typically high cost and very short-term, and therefore are used mainly for emergencies. Payday loans are called payday loans because they are always due in full on your next payday. Very creative, I know. While you may be able to find a payday loan online, most payday loans are obtained from storefronts. One of the benefits of a payday loan is that you can get the money immediately. So how does a payday loan actually work? When you go in to get a payday loan, you will receive the money immediately. The payday loan amounts usually are between $250 and $600. They rarely exceed that because they expect you to pay that money back in full on your next paycheck. And that means that you have to be prepared to have the money in time so that you can make that payment. If you don't have the money on your next paycheck, you have to roll over the loan. Rolling over the loan is just doing it again. And that means the fee is going to multiply at the same rate. So if you paid $30 for a $200 payday loan the first time and you can't pay it back at your payday, you're going to have to pay another $30 to roll it over for another 2 weeks. For this reason, payday loans can be really challenging. If you have a hard time keeping up with your budget, that means you may have a very hard time paying off a payday loan. That rollover cost can be extremely expensive. The cost of a payday loan is not calculated like many other loans. It's fee-based, which means for every $100 you borrow, you might pay between $12 and $15 for the privilege of borrowing that money for just a 2-week period. So what is the APR on a payday loan? Well, because they charge a fee, not an interest rate, it's not easy to calculate because an interest rate is calculated over the entire year. But a payday loan is based on just the time period you're borrowing the money for. And so for that reason, the 15% for just a week or 2 weeks can equate to a 350 or 700% APR. So why are payday loans so expensive? Why is the APR so high? Companies need to charge that fee in order to cover their overhead and to cover the chances that some people may not pay back. How do you repay a payday loan? There are typically 3 different ways you can pay a payday loan back. The first is to go into the physical store and make the payment. The second is that you can fill out a check and post date it, and they will cash the check on your next paycheck. The third way is that you can give the company access to your bank account and they can ACH the money out of your account on the day it's due. What's the difference between a payday loan and a personal loan or an installment loan? A payday loan is a single pay product, meaning you will make the payment in full on your next paycheck. An installment loan or a personal loan, you pay over time. That means that you may take out a larger sum of money, but that you might make a payment every 2 weeks or every month until it's paid off. Who qualifies for a payday loan? Or who can get a payday loan? Almost anyone can get a payday loan. Your credit score doesn't need to be high at all. You may not even have a credit score, and you can still get a payday loan. This is one of the reasons why many people use a payday loan, because they can't get access to credit in any other form. So how do you qualify for a payday loan? Well, it's actually quite simple. You just have to prove you're over the age of 18. You have to show you have a bank account in some cases, and you have to be able to show you have income. The company is still interested in making sure that you can pay them back. And because it's a payday loan, they want to make sure that you have a paycheck coming in so that you can make the payment. Do payday loan companies report to the credit bureaus? Typically, they do not. So a payday loan won't show up on your credit report. That can be a good thing or a bad thing. It's a good thing because it doesn't affect how other lenders may see you. It can be a bad thing though, because making a payment on a payday loan isn't actually going to improve your credit score. You're not going to get credit for that on-time payment. How fast can you get a payday loan? Well, almost as fast as you can show up at the store. Typically, payday loan companies issue the loan right there when you're standing in front of them. This is one of the most important features of a payday loan, and this is why so many people use them, because it's a fast way to get emergency money. What happens if you don't pay your payday loan back? Well, a payday loan is an unsecured form of credit, and that means the company can't come after your house or your car because you don't pay. But that doesn't mean they're going to leave you alone. They may call frequently to try to get you to pay. Now, there are federal rules and laws about how frequently or how they contact you, but many payday loan companies will skirt that law in order to get you to pay. The other thing about not paying your payday loan is that it's not going to show up on your credit report. What happens if you're having a hard time with the payday loan company you're working with? Where can you go to complain? The payday loan industry is regulated by each individual state. And that means if you have complaints, you need to contact your state regulator about your payday loan company. You can find a link to your state's regulator on the Yukon Project's website. I'll provide a link below. If you need an emergency short-term loan, what's a good alternative to a payday loan? Well, if you can get a personal loan, that's going to be a better option for you. You can also work with some lenders to delay payment on some of the bills. That can free up some money that you can use for the emergency that you have. And as always, you're almost always better off borrowing money from family and friends. So how many people actually use payday loans? Some studies suggest that between 3 and 6% of the US population has a payday loan at any given time. And in a year period, between 8 and 10% of the US population have them. Some people say that there are more payday loan stores than McDonald's in the United States. I personally can't find verification of that fact. There's no data out there, and part of the reason is because most payday loan companies are actually quite small, with just a handful of locations, or just one. And so it's really hard to identify. But clearly, if you've driven along many boulevards in this country, you can see payday loan stores in strip malls all over the place. Are payday loans risky? While the loan amounts are small and the loan terms are short, that can be one of the challenges. You have to pay the loan and the fees in full on your next paycheck. If you don't have the money, you typically have to roll over that loan. And what that means is taking out another loan for the same amount for the next period. This can become extremely expensive. And if you do it too often, it can be an incredible drain on your finances. For this reason, many people call payday loans a very risky form of credit. So are payday loans good or bad? Payday loans can be very expensive, and they can be a very challenging way to borrow small sums of money. If you can avoid using a payday loan, you probably should. There are many other ways in which to overcome a challenge. But you know what? If you're in a real bind and you know you're going to have money within the next 2 weeks to pay it back, a payday loan may be the option that you can use. This has been the Yukon Project's deep dive on payday loans. You can get more content like this on the Yukon Project website, or you can also subscribe here and get a lot more videos in the future. Thanks for joining us.